What's going on, y'all? Matt Garland here, NMLS number 58700, but I'm better known as MG the Mortgage Guy. We are live, we are blessed. Thank God for another day. Welcome back to another incredible episode of Rants and Gems. We're going to have a great conversation today. We're going to talk about Joe Biden's plan that he spoke about during the State of the Union last week about giving home buyers and home sellers a $10,000 tax credit, which should be interesting if it passes. Now, as always, if you're new to the channel, make sure you like, comment, share, subscribe, hit that bell for notifications, and always go to mgbookstore.com to pick up the latest and greatest books. House Hackonomics, The Real Estate Investors Manifesto. These are two essential books that you need to have to your collection if you are in your learning stage of real estate. All right. So, look, last week we had a special guest on, and if you attended last week's live for Rants and Gems, it was a lot of technical difficulties. This week, let's pray we don't have those same difficulties, right? I had a special guest, my guy, Carter Cofield. So when this tax credit announcement came out, I said, yo, Carter, man, we got to run this back for the people because the technical difficulties and everything wasn't in our favor. And I want to make sure the people really get a chance to hear you and really get to soak in your knowledge. So since we're talking taxes, I said, bro, let's bring in Carter again. So without further ado, because we're going to get this thing rocking and rolling ASAP, I'm going to bring in my brother, Mr. Carter Cofield, to the show. Carter, what's going on, my brother? How are you today?
Man, I'm blessed to be here, bro. Like every time we look up, there's a new tax update, right? Like there's something we need to talk about. So whenever there's a tax update, bro, you text me and say, hey, we got to get on Rants and Gems. We got to give the people the information that they need. And here we are.
Here we are, man. So let's jump right into this, man. We ain't gonna do no fluff on this episode. Let's get right to it. President Biden, during the State of the Union address, said he wants to give home buyers and sellers a $10,000 tax credit. Can you please break this down for us, Carter?
Yes. Well, before we talk about the solution, I think it's important that we spend a little bit of time talking about the problem, right? Because since the pandemic of 2020, home prices have risen over 27% in the last 4 years. And on top of that, interest rates have went up over 200%.
I
So
mean,
we
that
have
home
home prices.
appreciation, I don't need to cut you off, but that home appreciation is lovely, though, for us
Hey,
homeowners.
I bought in 2020.
I love it.
Dude, I bought it. I'm loving every second of it.
Yes, sir. We loving that. We loving that part. All right, let me shut up now. You go ahead, bro.
No, it's all good. It's all good. So home prices up almost 30%, interest rates up 200%. So in today's environment, it's almost impossible for some people to purchase the home of their dreams or any home at all, for that matter of fact. So the reason that President Biden came to the State of the Union to address this is because it's a problem that we all know needs to be addressed. So now that we know his problem, now that we know what the problem is, let's talk about his proposed solution. So there are two tax credits that he wants to implement in regards to home buyers. Tax credit number one is going to be a $10,000 tax credit for home buyers. Now it will be a $5,000 per year tax credit over 2 years. So it'll be $10,000 in total. And then the second tax credit he wanted to introduce is a home seller tax credit of $10,000. The home seller tax credit, you get $10,000 in year one. It's not going to be broken up over 2 years. And the point of this for the seller side of the business is like people who bought in 2020 aren't trying to sell their homes because they got an interest rate of 3%. And now they're about to go into an environment of 7%. So he wants to encourage people to sell homes so that the buyers have homes to buy. So I think if this is implemented, like this could help a lot of people get into homes.
Yeah, man. I think this definitely look, I think this is definitely a good thing, right? Anytime you're giving away money to promote home ownership is always a good thing. Now, one thing that they said in the announcement is that this is going to be for middle class families, right? But they did not break down is this going to be income restriction? Like, so it's always like something, right? They throw these keywords in, and that's why you got to really
Yeah.
pay attention. Because I know a lot of people is hype. It's like, yo, I'm gonna get, if I buy a house, if this get passed, they're gonna give me $10,000 over 2 years as a tax credit. But he said middle class families. Like,
Hmm.
so what's the definition of middle class families according to the government? Like, is it
Absolutely.
going to be like a certain income? Like, what's really
Hmm.
happening with that?
So I think, and that's a great question. I want to touch on that question, but I think before we get into that question, I do think it's equally as important that we let people know what the difference between a tax deduction and a tax credit, because like tax credits are so much better than tax deductions. So just to give you all insight, if you don't know already, if you get $100 tax deduction, right? You don't save $100 in taxes. If you get a $100 tax deduction, you have to take your tax deduction and multiply it by your tax rate. So if your tax rate is 30%, that means if you have a $100,000 tax deduction, it's only going to actually save you $30 in taxes. That's how tax deductions work.
Mm.
Tax credits are different. If you get $100 tax credit, it is going to lower your tax bill by $100. So I just don't want people to get confused. Like a $10,000 tax credit could wipe out your entire tax bill if you were to get it. So this is huge if you qualify. But now it's important to talk about who qualifies, because they did say middle income homeowners. So from the
Hmm.
research that I've done, and the only research I think is on the internet right now, the only concise answer I found is that this is for households with a joint income of less than $200,000.
Mm.
So, from what I know, that means if you're single, making less than $200,000, or if you're married, filing joint, making less than $200,000, you will qualify for this tax credit.
Okay, good explanation there. And I want to go circle back to the deduction and versus the actual credit. So
Mm-hmm.
just to be clear, guys, you're not going to get $5,000 as a refund, right? Like it's not they're not going to send you an extra 5K in your bank account or anything like that. So I just want that to be clear. And like you said,
Well, well, so I don't know if they didn't mention if this tax credit would be refundable or not, right? They didn't
okay,
mention that. But so what people need to understand is that like if you were going to have if you file taxes, or you were about to file taxes and you're going to owe $10,000, but then you get this tax credit,
now
it
you're
will
five.
take your well, yeah, exactly. You'll owe five, right? So it will lower your taxes. To my knowledge today, it won't be refundable. Meaning, if you owed zero and you got the credit, they'll give you $5,000 refund. So you still will like keep 5,000 in your pocket, but I don't think this is a refundable credit as far as we know today.
So let's just say if you owe no taxes, let's just say if you were going to get money back, let's just say $1,000, and you
Mm-hmm,
qualify for this tax credit. Now, with your refund, and again, this is based off of this is not in law right now, right? So
mm-hmm,
this is all speculation, right? So I'm just trying to
mm-hmm.
break this down for both sides of the fence so you guys can understand how this tax credit work, right? So if I'm going to get a refund of $1,000, then you apply this 5,000 tax credit. Does that mean now with a tax credit, I get 6,000 as a refund?
No, only refundable tax credits get added on top of your refund. So, like the child tax credit, if you already get $1,000 and you get the child tax credit, you get an extra couple thousand, right? Again, they haven't told us if it's going to be refundable or not. I would hope so, because if they really want to encourage people to buy homes, at least the people that they say they want to help, a refundable credit will help everybody out. So, hopefully, we don't know yet.
Hopefully.
Hopefully,
Hopefully.
yeah,
Key word,
yeah,
ladies and gentlemen. Everybody type hopefully in the comments. Very key word right there. All right. So
yeah.
now that's the home buyer part of this plan that he spoke about at the State of the Union address. But he's also encouraging home sellers to sell and
Mm-hmm.
give a tax credit as well. Now, this part of it, I actually like a lot more than the actual home buyers, right? Because we have an inventory issue here in America.
Mm-hmm.
Um, we don't have enough inventory on the market right now. The housing market is locked because majority of America, if they have a mortgage, they're below 4%, right? So what's the incentive for me to sell besides me making this a bunch of equity if I sell, but now I got to be subject to these higher interest rates too. So let's break down the home seller tax credit that he was speaking on at the State of the Union as well.
Yes. So to your point, bro, like if you bought a home in 2020, you are up big on your home purchase, and you got it at such a low interest rate. If you sell, you're gonna one, create a taxable event, and then two, you're gonna, if you want to buy again, you have to deal with these current interest rates. So he's really, really enticing sellers to sell. That's why the tax credit is 10,000 in 1 year versus split up over 2 years. He understands he has to really, really push people to want to sell. Now, here's the interesting thing, because again, with the IRS guys, you have to read the fine print. According to the latest publication, there are limitations on the seller credit as well. If you want to qualify, your home, you would have to sell what's quote unquote a starter home, which their definition of a starter home is the home has to be within the median price range of that neighborhood. Meaning, if you got the best house on the block, you don't qualify. But so you need to have if you're going to sell it, you need to sell it for a price that's within the median of your neighborhood. On top of that, if you want to qualify for the seller tax credit, you have to sell it to another owner occupant. You cannot sell it to an investor who's then going to rent it out. You need to be selling to somebody who's trying to move in. They're trying to match the people who qualify for the home buyer credit with the people who match with people who match against the seller credit, not just investors. So that to me really sucked, because like, shouldn't matter who buys it. Like, it should be bought, but it has to be a medium price point, and it has to be to owner occupant.
I agree with you 100% on that one, right? First of all, I don't like the medium area price. You know, for me, like if my house is worth $2 million and I sell it, give me a credit for selling my house. Like, who cares what the medium home price is? And who cares if I sell it to an investor or an owner occupant? Like, this is when I think, the government gets it wrong. It's like you're trying to make things more difficult than what it is, right? And it's at that point, it might not even be worth it for the $10,000 tax credit if I can get more money from somebody who says, hey, they like my house and they want to use it as investment property. You know what I'm saying?
Mm-hmm. Yeah, and guys, I want you all to understand that what we're saying, because we do understand that a lot of the corporations and a lot of institutional investors are taking up the homes, which is partially why we have a problem in the first place. Our problem is, if I'm a seller and you want to motivate me to sell, don't make it hard, because I don't want to sell in the first place. Don't make me have to sell it at a price lower than I want to sell it to, than I want to sell it at. And then on top of that, when as a seller, institutional investors or investors, period, they are willing to pay a higher price than somebody who's just trying to live there. So my thing is, if you're trying to encourage me with a $10,000 credit, I could just not take the credit and somebody might buy it for $10,000 more. You know what I'm saying? So I think that that's
Yeah.
what we're trying to communicate. We don't have a problem. We understand institutional investors, but like, yo, I don't want to sell in the first place. You gotta motivate me, and then you give me all these rules. That I think is where the problem is.
Yeah, and it's a big problem. And again, we understand, like you said, institutional investors are buying a lot of homes in America, especially single family homes. We get all of this. But again, you should not dictate who I can sell my house to. Like, give me the credit because I'm actually selling the house and opening up inventory, right? Because that is the goal, is to open up
Mm-hmm.
inventory so more people can buy. Now, if an investor comes in here, whether it's institutional or mom and pop, right? Either which way, if they want to offer me more money, then hell, I'm gonna take the more money and say screw your tax credit anyway. So it is what it is, and it ain't what it ain't.
Yeah, and I think one thing that would empower your audience, guys, like we should all be looking at each other, at ourselves as investors, right? Like let's take that empowering state of mind, right? Like we should all be looking at ourselves as an investor. Like if you want to buy a property and put somebody else in it, like that's fine. But like I don't want us to take the narrative of we're only buyers. We're buyers and we're investors. So I hope that like equips the audience with the right mindset going into this on who they really are.
No, I agree with you 1000%. All right, let's go to the next topic, right? Because we were talking offline and you were telling me when you purchased a new property of yours that you used the 3-2-1 buy down um, when you bought this property, right? So let's break that down, because not only you're an entrepreneur, you know, you are also a real estate owner and investor as well. So break down the 3-2-1 and how it helped you with your last purchase.
Bro, first of all, I had no idea what a 3-2-1 buy down was. I had no idea it existed, but today that is one of my favorite terms in the English language. You hear me? I'm like, oh, real estate is dope, bro. Um, so a three guys, for those of you all that don't know, a 3-2-1 buy down is a strategy that you can leverage when you're purchasing a home to buy down your interest rate for a certain amount of time. So, for example, if you're about to buy a property and it's at 7% interest rate, what a 3-2-1 buy down would do is in year one, you will buy down your rate by 3%. So it'll be 4%. You have a 4% interest rate in year one versus 7%. And then in year two, you will have a 5% interest rate because now year two, you're buying it down 2 points. And then year three, you'll have a 6% interest rate. And then when it's done, you'll go back up to the 7, right? So you essentially get to enjoy COVID interest rates in today's economy. And like, here's the even doper part about it. The interest that you save can be astronomical. So for my example, I just bought a $1.1 million property. My 3-2-1 buy down saved me $50,000 in interest in the first 3 years.
Wow.
$50,000 in interest. And guess what? I don't have to pay for the buy down. The person who's selling the home is paying for the buy down. So I don't have to do anything. If he wants to sell, he'll pay for the buy down because he's about to cash out anyway. And I save $50,000 in interest over the first 3 years. It's the best thing since sliced bread, bro.
So let's break this down a little bit more, right? Because that's a lot of money saving, right? 50K is nothing
50K.
like, right? So you say 50,000 in interest savings over that first 3 years during your buy down, correct? Now,
Yes.
okay, go ahead. Go ahead. You're about to say something. I feel like you're about to drop a gem.
Yeah, I'm sorry, bro. I'm excited, bro. Bro. So, and what I found out is that because again, you don't have to wait out the buy down period. Let's say I take the 3-year buy down year one, but yes, let's say year two, interest rates come back down. Let's say interest rates come back down to a point where I want to refinance, right? Because the new rate might be lower than my buy down rate. If I refinance in year two or year three, I get to cash out and get a check for the interest that I saved. So of the $50,000 in interest, if I used up $20,000 of those savings in year one, but I decide to refinance in year two, I get $30,000 in my bank account because I didn't take out the full buy down, which is wild.
Interesting. So from a tax perspective, like break that down a little bit more because you kind of lost me on that one. I do buy
Okay.
downs and I know you refinance like you just refinance, right? So how are you getting this money back if you refinance early?
Because so the seller paid the bank, he paid the $50,000 in interest that I saved. So he has to pay for that. So that money is put in a bucket. And
Okay. Now you caught me up. Okay.
You know what I'm saying? So I'm saying
Copy.
yeah, if you were to refinance before the 3-2-1 period is over, any excess savings you get to keep in your pocket. That's it.
Yeah, because it's in the escrow. Let's call it an escrow, right?
Exactly.
For the buy down. That was a gem,
Mm-hmm.
right? Now from a
Yeah.
tax perspective, right?
Mm-hmm.
Because all the buy down is prepaid interest and AKA points, right?
Mm-hmm.
So from a tax perspective, although the seller paid for this, you as the home buyer still get to benefit, correct?
bro. Yes. So first of all, yes, and this is where things get nutty, right? This is where things get insane because I had to do some thorough research. I'm like, wait, because I know points can be deductible on your taxes, right? So I had to do some research. Well, like, what if the points are paid by the seller? And so, from what I found in my research, is that for a 3-2-1 buy down, it's paid by the seller, but like for all intents and purposes, it's looked at as paid by the buyer. So that $50,000 worth of interest that you saved is going to be tax deductible in the first year of the buy down. So not only am I saving $50,000 in interest, but I'm going to get a tax deduction as if I paid that $50,000 in interest up front when I didn't pay for it. The seller paid for it. So now I'm enjoying, like, just to give y'all clarity, the difference in monthly payment is over $2,000 a month, right? So for
Sheesh.
this property, the difference in monthly payment is over $2,000 a month. So I'm saving $2,000 a month in like real cash flow. On top of that, I get a $50,000 tax deduction as if I paid for the points myself. So this is like where I'm like, I knew real estate was dope, bro, but now I'm all in. Now, like, I'm all in. I'm all in.
Like that's all you needed to see, right? So not only
I'm
can you save
done.
the monthly interest and the monthly payment, but now you can also deduct all of these savings pretty much immediately, right?
Yeah,
Well,
yeah.
and
So
this is if you itemize.
yes, this is if you itemize, right? Which do $50,000 tax deduction is going to make everybody and their mama itemize.
That's a fact.
You know what I'm saying? So yes,
So you're able to take all that interest savings over the 3 years and itemize year one.
year one. From our research, you can itemize it year one.
Wow,
Yeah. As if you
that's
pay, because it's
crazy.
prepaid.
It's
It's pre
prepaid.
like the thing about the tax system is like if you prepay expenses in your business, you get to take them even though you didn't need to pay those expenses yet. So if in December, if I want to prepay my marketing expenses for January and February, even though I haven't incurred those expenses like in real time, if when I pay for it is when I get the deduction.
Mhm.
So the same counts here.
So we got a quick question from Gavin St. Clair. He says, "So what's the benefit? What benefit is there for the seller to do this with all caps, right? In your situation, let's talk about it. What was the benefit of the seller uh, to offer you this buy down?
He made $1.1 million.
Very simple.
like,
Very
like, like,
simple.
like, yeah, like so. But to answer the question, more in depth, he was a motivated seller, right? Because like selling in this interest rate environment, they know it's hard. Like the interest rates is cutting into everybody's margins. So think about this. Instead of he could have gave me a $50,000 reduction on price. That's what most people would do. Say, hey, take it from 1 million to 950,000. Cool. But guess what? You don't benefit today off that $50,000 deduction in price. You
Correct.
benefit a little bit every month for 30 years. That's what we call the slow boat to China. We're not taking that route. Instead, that same $50,000 took down on price, he can just pay for my 3-2-1 buy down. And I get the benefit today. So just like knowing that simple difference is the difference of tens of thousands of dollars in your pocket. That's why we say like information changes situations, bro.
Information definitely changed the situation. I'm glad, Gavin, that you asked that question because, like you said, why would I reduce my price 50,000, 75,000, 100,000 just so I can get more buyers in the mix? If I have a qualified buyer right here, why not offer them this seller's concession, right? Which can now be used towards the buy down, get them a much cheaper payment. And if the seller and the realtors, they understand tax strategies, they understand interest savings, they'll be able to articulate that to their sellers, right? And to the buyers and the buyer's realtor. So that way a deal can be had and the house can be sold. Because remember, the longer the house is on the market, Gavin, it's going to get stale. And you don't want your listing or your property to get stale. You want it to sell, not sit, right? So what do you want? You want to let your house sit for another 90 days or so, or you got Carter Cofield, who's well qualified to purchase today. But if you
Yeah.
offer him this incentive, he's going to jump on it. And that's what you did.
Yeah. Because I was kind of motivated to buy. When they told me that, I said, print out the paperwork. Okay. Like there was no more conversation about print the paperwork. I'll see you at closing.
Yeah.
Period.
Not tomorrow, right now. Let's
Yeah,
go.
exactly. Exactly.
Let's go.
Exactly.
Right.
Exactly.
So, all right, let me answer this quick question from Ben Klassen. Ben says, does the 321 buy down extend over 3 years or go back to the original interest rate? So, okay, so let me break this down for you, Ben. And for those of you who probably didn't really, listen to what my brother Carter was saying, right? 321 buy down basically means your interest rate goes down by 3% year one, 2% year two, 1% year three, and then year four, it's what the original rate would have been at that time. So, for example, if the going market rate today is 7% on a 30-year mortgage, and you do a 321 buy down, that means year one, your interest rate will be 4%. Year two, it will be 5%. Year three, it will be 6%. And then year four, it will be 7% for the life of the loan. Now, with most 321 or any buy down strategies, you don't want to, if the interest rates drop within that first 3 years, you want to be able to refinance out of this 321 buy down. So it's kind of like giving you like a teaser rate, so to speak, uh, for the first couple years to make home ownership more affordable. And this is why in the beginning of this topic we were talking about President Biden's tax credit, right? Because they were saying that this tax credit is the equivalent of saving someone 1.5% interest, on their mortgage for the first 2 years as well, right? Interest rates are high. We're about 7% right now nationally. And that's if you got perfect top tier A1 credit scores. So if you got,
Talk
you
about it.
know, 680, 700 credit scores, you might be 7.5, 7.75. So what they're trying to do while we're in a higher interest rate environment, the banks are trying to continue the home ownership, continue to help people get into homes. And buy downs is a perfect way to give someone that affordability that they might need for the first couple years while we wait for the market to correct itself. Make sense, Ben? Hope it makes sense.
That was
Type
a
yes.
thorough explanation, bro. Yeah.
So, all right. So we're coming up on 30 minutes. We at the halfway mark on this, my brother. And you dropping a lot of gems on this, man. Make sure y'all throw some gems in the comment for my brother Carter Cofield. And since we're sitting here talking about taxes, we spoke about points, buy downs. Let's further this conversation, right? Um, House hacking, tax benefits. What does that look like? How can we maximize the tax code as a house hacking home buyer?
Yeah. So I think a few things. So, number one, you need to understand the difference in tax deductions when you're a homeowner versus a investor, simply meaning that you now rent out partial or all of the property. So when you purchase a home to live in, there are only a few tax deductible expenses. Mortgage interest, you used to be able to write off PMI, but they took that away. So it's mortgage interest and property taxes. Those are pretty much the only two tax deductions that you get to deduct if you purchase a home where you're going to live. So that means the repairs are not tax deductible, home insurance is not tax deductible, HOA fees, none of that is tax deductible to you. But when you're an investor, that list of tax deductions dramatically increases. So when you buy a home to rent out, you're able to write off mortgage interest, property taxes, along with HOA fees, property insurance, utilities, repairs and maintenance, and this phenomenal tax deduction called depreciation, which basically the IRS allows you to write off your property as if it's going down in value when it's actually going up in value. So your amount of deductions dramatically increase when you become an investor. So what house hacking allows you to do, it allows you to have the best of both worlds. You can buy a property, you can live in one of the units, and rent out of the other two, so you can still take advantage of an amazing opportunity like a FHA loan, which allows you to put down 3.5%. So you can take advantage of the home ownership benefits while simultaneously getting the tax deductions as if you were an investor. So in my example, I bought a property a couple years ago in Chicago. It's a three flat, so three-bedroom units on top of each other. I lived in one unit and rented out the other two. What that means is 33% of that building is personal, but 67% of that building is a business. So that means that I get to write off 67% of property taxes, 67% of homeowners insurance, 67% of depreciation, 67% of repairs, maintenance, any property management company, all the expenses that I was going to pay for that building anyway. Now 67% of it, or 2/3, is tax deductible. So house hacking not only allows you to live for free, but it also allows you to save a lot of money on taxes.
Gems, gems,
Yeah, let
lots
me.
of gems, lots of gems. God, you on fire right
Yeah,
now, bro.
yeah. I was, let me. I think I had to burn the light out. Let me turn my light on right quick.
Yeah,
So I can
you
get
on
some light
fire.
in here.
You're on fire so much, man. You got the damn lights turning off. Like,
Yeah, yeah, yeah. My bad, brother. My bad. We back. We back. We
so,
back. But like,
so
yeah.
go ahead, go ahead.
No, I was just saying, like the importance, like guys, learning about taxes is not optional. Like saying that my tax guy knows, like that's not optional anymore. Like being ignorant of the tax code is expensive. Like I know our parents taught us ignorance is bliss. That is cap. Ignorance is expensive, especially ignorance when it comes to like the tax code and tax strategies, because everybody's number one expense, more than your mortgage, more than your car note, more than your kids, everybody's number one expense is taxes. So the quicker you're able to lower that expense, the better off your life will be.
Agreed, agreed. So look, I know we're talking about if you owning the property and you live in there, you get all these great benefits, right? While you in ownership, but what are some of the tax implications when you selling a property that you house hacking?
Okay, so the biggest worry for people who house hacked and then sold their property later is they have to pay something called depreciation recapture.
Mm,
What that means is, let's say over the 3 years you were renting out the home, let's say you wrote off $60,000 in depreciation, $1,000 in depreciation recapture back. So that is probably one of the main caveats of selling your home. But there are always ways to get around this, right? There are always ways to get past this. One of those ways is what's called a 1031 like kind exchange, which basically means that you will be, like, if you sell the property and buy another like kind property within 180 days, that that recapture or that depreciation you have to pay back, you don't have to pay it back. It rolls into the next property. So you can keep kicking this can down the road over and over and over again, buying a property, selling it, buying another property, selling it, buying another property, selling it. And then when you die, guess what? Your kids aren't responsible. That money that you owe just poof goes away. So there are ways around it, MG, as long as the long way of saying it.
man, that was a lot of game, man. That recapture of your depreciation is big time
Mhm.
gems. 'Cause a lot of people don't know about that, and you want to pay attention to that because you can have a hefty tax bill when it comes to that, and then also the capital gains. And that's why, like with capital gains, if it's owner occupied, correct me if I'm wrong, you have to live in it as an owner occupied property for 2 years, right? And then if you live in it for 2 years, then you can kind of avoid the capital gains.
Yes. So if you live in a property for 2 out of the last 5 years, so you can live in it 2 years, rent it out 2 years, and still sell it. So you got, if you're living there 2 out of the last 5 years, you get to sell it and you get what's called the homeowners exclusion, which basically means if you're single, up the first $250,000 of money you make from that sale, not taxable. If you're married, the first $500,000 you make from that sale, not taxable. So if you're married, you buy a property for 300K, you sell it for 700K, that $400,000 is tax free, which is wild.
It's crazy. Crazy.
Yeah,
And those who bought in 2019, 2020, 2021, and early
Scott.
2022, you're probably going to make $250,000 or more right now. So this is good information for you if you decide to sell within the next couple years, because you guys are up and stuck because you probably listen to MG. I appreciate y'all. All right, so look, we're coming up on almost 40 minutes here, bro, and you were kind of going in and out a little bit, and it was
Okay.
getting a little pixie. So I don't want these gems to be wasted like last week happened, because I feel like the algorithm is going to try to do the BS on us. I want you to tell them about how to find you, how to lock in with your movement, and what else you got going on.
Yeah, so I would say the one of the best opportunities they will have to really keep learning this stuff is I'm doing a 5-day virtual training, like live, teaching every millionaire tax strategy I know. How to write off your cars, how to write off your rent, how to write off your mortgage, all the real estate tax strategies. I'm teaching everything I know over the next over a 5-day virtual training, and that training is coming up in a few weeks. And so, if you want to be a part of that, and I promise you, if you join the training, by the time that you leave, not only will you have saved $50,000 in taxes, but you will probably know more about taxes than your current accountants. So, if you want to be a part of that movement, all you have to do is go to taxfreechallenge.com. Again, that's taxfreechallenge.com. You can grab a ticket. MG, we talked about it before. I'll give anybody that comes from your audience automatic 60% off if they want to be a part of this room. But like, I only do this once a year, and this will be a phenomenal opportunity for you to like learn how to save more so that you can actually earn more. It's not about how much money you make, it's about how much money you keep.
Very important. How much money you keep. And I put the link in the comments right now, taxfreechallenge.com. Make sure you guys tap in with that. Oh, I spelled free wrong. Let me the internet trying
Yeah.
to internet me right now. So let's delete that. And let's go to www.taxfreechallenge.com. Make sure you guys go sign up. Go follow. How can they follow you on all your
Yeah.
social media platforms, your YouTube, all
Yeah.
that stuff?
Absolutely. So I think honestly, YouTube would be probably the best channel to follow because we're giving out long form game there. So if you want to follow us on YouTube, that is Melanin, like the skin tone, Melanin Money on YouTube. Put out videos 3 times a week, 100% free, obviously. And then Instagram is Cofield underscore advisor. So Instagram, Cofield advisor, YouTube, Melanin Money. If you want to learn how to save $50,000 in taxes in 2024, go to taxfreechallenge.com. And dude, I'm ready to go. As you can see, how excited I get about this
Man, like
stuff. Like it's gonna be crazy.
nah, Carter Cofield is one
Yeah.
of the best in the business, one of the best CPAs out there. He's given a lot of game, and look, you got there giving out content 3 times a week on YouTube, man. So make sure you guys tap in with the YouTube channel as well, because like you said earlier, this is no longer the days where you can rely on the professional to give you all the answers, right? I don't care if it's a tax professional, a real estate professional, a banker, loan officer, whatever it is that you're looking to do for your life, you have to be the CEO of your business, and you have to run this like your life as it's a business, because it is, right? And depending on somebody else's word without you having the knowledge, those days are done. Our parents did that shit, right? Let's call a spade a spade. Our parents didn't know nothing, and they trusted everybody, and they made a lot of mistakes along the way. This is how we break generational curses, right? Is the more you learn, the more you earn. So taxes is an extremely important part of generational wealth. Let's not get it twisted. It's not about how much money you make, it's how much money that you keep. And the more money you keep, the more you're able to invest and grow your portfolio in your life. So I want y'all to throw some gems in the comment for my brother Carter Cofield. Make sure you go to taxfreechallenge.com. Sign up for the challenge. Get that 60% off today and go to his YouTube channel. Tap in with the gems and make sure you support this brother. Carter Cofield, my brother, I appreciate you. Any parting words for our Rants and Gems audience?
No, bro. Just stay tapped in. Ranch and Gems is an amazing show, and whenever you already know, whenever you need me, whenever another update comes,
Say
we
less.
outside, bro.
Say less. Oh, let me give you an update from that what you told me in April. We good on that.
We good?
We good. We good on that on April, right? I'm not gonna say what
My
it is
dog.
because I don't know if you put it out there yet.
Yeah,
You know
yeah,
what I'm
no.
saying?
Leave it at that. Leave it. It was that exactly what you said. Hey, my dog. Appreciate it, brother.
We good,
Appreciate it.
brother. We good. We good for April, man. So look, Carter Cofield, ladies and gentlemen, Rants and Gems. Tap in, download us on all podcast audio outlets. Yo, you ain't got no books out yet, bro?
No, I'm gonna get like you when I grow up, bro. I ain't there yet.
Man, we gotta get you some books out here, man. The people need to
We do.
read, man. You can't forget about
You're
the
right.
readers, brother.
Hey,
You know what
look,
I'm saying?
that's what they got you. Until I just have to grow up, I'm sending them all to MG, man.
There you have it, ladies and gentlemen. So look, go to Melon Money, tap in with the movement. How do we get the 60% off? I think I missed that part. Good question, Camilla.
So no, I already have the team updated. So
Okay.
like it's already on the page.
Embedded.
So they click the link. Yeah, it's already embedded. So yeah, once they click the link, it'll automatically show the old price sliced out with the new price.
There you go, Sister Camilla. There you go. Go to taxfreechallenge.com. Get your tickets for the challenge. All right, y'all. So we're going to tap out. Make sure you like, comment, share, subscribe. Hit the bell for notifications. Rants and Gems, we are back, baby. Carter Cofield, appreciate the love. Everybody, thank you for the support. And leave your thoughts in the comments on the 3 topics that we spoke about today. I would love to hear from you guys. All right? Matt Garland, NMLS number 58700, but I'm better known as MG the Mortgage Guy. Peace.